Welcome back to the Deep Dive, where we take your sources and turn them into actionable insights. We've got a pile of material here on Kumpulan Perangsang Selangor, or KPS, and we're zoning in on their latest Q3 2025 report from November 24th.
Yeah, this is a really important one. We looked at their Q1 numbers earlier this year, but we skipped Q2. So this Q3 check-in is pretty critical to see where things actually stand.
Yeah, and there's a real puzzle here that we need to solve for you today. KPS reported this, just massive jump in their bottom line. Profit attributable to owners, up 418% year on year. That's a huge number.
It's a headline grabber for sure.
It is, and yet the stock price is just stuck. It's sitting around RM0.625, still on a downtrend.
Right. The market response has been, let's say, lukewarm at best. That 418% figure is eye-popping, but it's clear the bigger players are looking past that headline.
Exactly. So our mission today is to unpack that profit spike. We're going to dig into the quality of those earnings, see which parts of the business are actually working, check in on their debt reduction, and, figure out the real outlook here.
Especially with all the global challenges they're facing.
Before we jump in, if you find this kind of analysis helpful, please do us a favor and hit that like button and subscribe to the channel. It really helps us out. Okay, let's get into it. Segment 1. The headline numbers and this paradox.
Okay, so let's start with those huge profit numbers. Q3 2025 versus the same time last year, Q3 2024. Profit before tax, PBT, shot up 164% to RM1205 million.
And as I mentioned, that profit for the owners, that massive 418% jump, it landed just under RM20 million. Earnings per share also leaped from 0.7 sen all the way to 3.7 sen.
I mean, if you just read that part of the report, you'd think the core business is absolutely on fire.
Right. But here's the catch, and this is really the key to why the stock is struggling. Revenue from their continuing operations actually went down.
And that's the disconnect. Revenue was RM268.7 million. That's down about 3% from last year.
So profit goes up by 4 times, but sales are shrinking. That immediately tells you something non-operational is going on.
Exactly. The earnings quality is questionable.
So let's break it down. That RM15.5 million improvement in PBT, how much of that was from actually, running the business better versus some kind of financial engineering?
Very, very little came from core operations. The lion's share was driven by 2 main things, both non-core. First, the biggest piece of the puzzle, a huge one-off gain of RM10.5 million.
Okay, and where did that come from?
They sold a factory. It was the disposal of Century Bonds or CBB's plant in Nilai.
So selling an asset and booking the profit.
Yeah.
A one-time event.
A one-time event, precisely. The second driver was basically less bad news on the currency front. They had much lower net foreign exchange losses. That saved them about RM9.5 million compared to last year.
So if you strip out the asset sale and the favorable currency swing, the core story is that sales are actually shrinking. The company just looks great on paper this quarter.
That is the essential takeaway. And if you look quarter on quarter, so Q3 versus Q2 of this year, it becomes even clearer. Well, revenue was basically flat. RM268.7 million, almost identical to Q2. But PBT still jumped up from about RM17.6 million to that RM25 million figure.
And the difference is that RM10.5 million gain.
Exactly. The Nilai plant sale is what held up the entire quarter's profit. Without it, PBT would have actually fallen from Q2, so you can see why the market is being so cautious.
Right. The underlying engines are sputtering a bit. Let's dive into those engines now, starting with manufacturing. This is their main business. What's the story there?
It's a tough story. The sector's revenue fell by RM9 million year on year. Most of that hit came from Toyopolis Manufacturing Malaysia, or TMM.
Why them specifically?
KPS says it was because of an early stop push-out before a tariff went into effect in August.
So they basically sold a bunch of stuff early to beat the tariff, which means those sales are now missing from this quarter and maybe future ones.
That's the risk, yeah. And it wasn't just them. Century Bond, CBB, also saw its revenue drop by 8%. So we're seeing weaker demand across their key manufacturing units.
Okay, but even with those weak sales, the manufacturing sector's profit, the PDT, jumped 75% to almost RM30 million. I think I know the answer, but tell us why.
It's that same one-off gain. It was almost entirely the profit from selling the Nilai plant. Now, to be fair, a couple of their smaller units like CPI and MDS did do better, but the huge sector-wide jump was an accounting event, not a sign of a booming business.
That distinction is so important. Okay, what about the other parts of the business? Trading seems to be holding its own.
It is. Trading is sort of the steady hand here. Revenue was up a little, about 5% to RM45 million. Profit was down slightly, but it's basically stable. No major drama there.
And the non-core stuff they've been trying to clean up.
That cleanup is pretty much done. Property investment. Zero revenue. That confirms the Plaza Perangsang sale is completely off the books now. Infrastructure also had no revenue, but its profit contribution was actually up a little because of their associate companies.
And oil and gas.
That segment was weaker. Profit contribution dropped by about RM2.4 million. Management says that's mainly because of lower domestic LPG sales, so even their non-manufacturing units are feeling the pinch from weaker local demand.
Okay, but on the bright side, this strategic cleanup we talked about last time seems to be working. The winding up of those non-core subsidiaries is moving along.
Yeah, they're being pretty efficient with that. The Vietnam operation was wound up in August, and the Shanghai one was done back in April. KPS is definitely becoming a much leaner, more focused company, which is a good strategic move, even if it's happening during a really tough market.
So that brings us to the real success story here, which is the balance sheet.
Yeah.
All this asset selling was meant to build up financial strength. How's their cash flow looking?
It's phenomenal, and this is the company's silver lining right now. Net cash from operations for the first 9 months of the year, it jumped to over RM83 million.
Wow, and what was it last year?
Last year for the same period, just RM707,000. So it's an enormous, enormous improvement in their liquidity.
And that cash has gone straight to paying down debt, right? That was the whole plan.
That was the mission, and they've executed it really well. Total borrowings are down from RM175 million at the start of the year to about RM137 million now. They've wiped nearly RM40 million of debt off the books in 9 months.
And that's not even counting the long-term benefit of paying off things like their sukuk.
Absolutely. That was settled back in July of last year, and now you're seeing the full effect. Their finance costs are way down, which helps prop up the bottom line, even on the operational side, because they're just paying less interest.
Which brings everyone to the dividend question. With a 418% profit jump, you'd think they'd be rewarding shareholders. Any new dividend?
Not this quarter. No interim dividend was declared. They did pay out that final dividend for 2024 back in June, but that was really funded by those earlier asset sales. Right now, it looks like they're choosing to hold onto the cash and keep the balance sheet strong.
So back in Q1, we talked about how analysts were split. Some said hold, some said sell because there weren't any short-term catalysts. Seeing these Q3 results, does this confirm that cautious view?
It confirms it completely. The analysts who were worried about a lack of operational growth were spot on. KPS has done a fantastic job on the financial side. The balance sheet is healthier than it's been in years, but that doesn't fix the problem of falling customer demand and fierce competition.
So financial stability is there, but the actual business recovery is still a question mark.
The big question mark.
Let's talk about that outlook then. What is management saying about the future? Are they optimistic?
Not at all. They're being very cautious. The report says the operating environment remains challenged, demand is uncertain, and this is key customers are actively avoiding building up inventory.
Destocking.
Exactly.
Right.
That customer destocking is putting direct pressure on their sales numbers.
And you mentioned competition. The report was pretty specific about a new threat, wasn't it? The price wars.
This is probably the most serious long-term threat they mentioned. They pointed out that companies from China are setting up shop right there in Malaysia and are, and this is a quote, slashing their selling price to grab market share.
Wow. That changes everything for their manufacturing units. If new competitors can just come in and undercut you on price, your margins get crushed. You have no pricing power.
None. And management even says it threatens local long-term sustainability. That's strong language. Their strategy now is just to be adaptive, cut costs, be more efficient, find new suppliers, diversify. But that's all defensive.
Okay, so with all that in mind, great balance sheet, but severe pressure on the core business, let's revisit our financial Moat score. We gave them a 4 out of 10 last time. Are we sticking with that?
We are sticking firmly with a 4 out of 10, and it's because it perfectly captures this split personality of the company right now.
Oh, so?
Well, the debt reduction and the cash generation have built a really strong financial moat. That's the positive. They have this armor of liquidity.
But the business itself?
The core business has no real operational moat. Not right now. When you're forced to rely on selling assets to make your profit numbers look good because competitors are eating your lunch on price, you just don't have a sustainable competitive advantage. The financial strength lets them survive the storm, but it doesn't win them the war.
The armor is strong, but the sword is blunt.
That's a great way to put it.
All right, before we wrap up, any updates on those legal cases we've been tracking?
Yeah, quick updates. The hotel employee claim, that trial's decision came out in July. KPS is appealing it, and the next key date is case management at the Court of Appeal on December 11th. So that's coming up soon.
And the land claim case.
That one's moving much more slowly. The trial itself is still scheduled way out for March of 2026.
Okay, let's pull this all together.
To sum it up, KPS in Q3 is a story of a brilliant financial cleanup. They used asset sales to slash debt and ended up with a sensational profit number thanks to that one-off gain. They're leaner, they're financially much safer.
But the big but is that the challenge has now shifted entirely to the operational side. Their main businesses are fighting weak demand and, more importantly, this new, aggressive price war from competitors. Their good finances have bought them time, but it hasn't solved the core problem.
And that leads to the final thought for you to consider. KPS has now played its best cards on the financial side. They've sold the big assets, they've cut the debt. The next chapter, heading into 2026, has to be about organic operational growth.
So the question is, can their strategy really protect them from these price wars and the weak global demand? Can they start delivering consistent profits from their actual business?
That's the metric to watch. That's what will ultimately decide if the stock price ever breaks out of this downtrend.
Absolutely. Thank you so much for joining us for this deep dive and for sending in your materials. And for everyone listening, don't forget to hit that like button and please leave a comment with your thoughts. Can KPS win this operational fight? And be sure to subscribe for more insights just like this. We'll see you on the next one.